Hello and welcome back to AEF TV in association with Engerati. We're joined now by Keith Martin, who's part of the Initiative for Risk Mitigation of Africa. That's a bit of a mouthful, from the African Development Bank. And Keith, firstly, welcome to the studio. Thank you for making the time to join us.
Thank you.
And one of the things that we were talking a little bit off air, and I mentioned some of the mega trends that PwC were talking about within Africa, and some of the work you're doing kind of goes towards one of those, which is about the increased appetite for investment within Africa, but also the changing landscape of appetite of investment within Africa. So just tell us a little bit about what this fund is. It's a trust fund from the Italian government. Just give us a bit of background and context on
Correct. So there was a study some years ago from the OECD that confirmed what most of us already assumed, which is that one of the impediments to investment, and in particular to project finance for investment in Africa, is the lack of adequate risk mitigation, both the availability of such mitigation, the pricing, the terms, etc. So the government of Italy decided to fund this special trust fund, which aims to try to help in terms of this perceived gap of risk mitigation, both in terms of building the capacity of governments and other stakeholders in the countries, private sector, banks, etc., as well as helping the African Development Bank itself. We're housed within the private sector group of the African Development Bank to help with specific projects, because the idea is if the risk mitigation profile is better, the financing will be better, and our member countries will benefit as a result.
So how does this work? So just to get into the nuts of it a little bit. Basically, there is a project, and I'm speaking hypothetically here. There is a project, and you look at it, and the potential investor goes, you know what, the risk profile is too high. Because you were talking off air a little bit about there are a number of different tools, not just this trust fund that you can draw on to mitigate some of that. Just paint a picture a little bit about where all of those are and the challenges.
Sure, we act as a catalyst. We aren't insurers ourselves. The African Development Bank doesn't do insurance, but we have, for example, within the African Development Bank, partial credit guarantees, partial risk guarantees. But our role within the trust fund is to make sure that all the parties are aware of all of the options that are available. So political risk insurance is available, for example, from other providers. There may also be other risks that are not insurable through political risk insurance, but there are other ways to mitigate them. So we work very closely with the project teams to try to ensure that everything is done to make the project bankable from a risk perspective. So that's our project-specific focus. And as I mentioned before, we also work very closely with the governments of our host countries to try to improve the capacity that they have on their side to know about how they can build in risk mitigation tools that will eventually help lower the cost of the financing of projects.
So this is giving them the skill set and the knowledge to structure their projects in such a way that make them more bankable in the first place.
Exactly.
So on that side of things, where it's about that sort of bankability of the projects, how much work needs to be done with sort of the governments and the government ecosystem in the first place before you start taking that to the trust fund or using all these other things?
Well, I'd say that varies a lot from country to country. I think what we've discovered in general is that there is a risk perception gap vis-a-vis Africa. That is to say that if we look at there was a study done, for example, a couple of years ago, in fact just last year, on investors who have come into, multinationals that have come into Africa and their perception of Africa as a region for investment versus investors who have not. So investors who have not generally perceive Africa as being the least attractive region. The ones who have already been there perceive it as the second most attractive after East Asia. So there's a massive gap. Part of what we would do is work with the governments on that, but also in terms of many times within the governments, there's not a clear perspective on all of these risk mitigation tools that are available, our own partial risk guarantees and partial credit guarantees, but also political risk insurance from the private market, from MIGA, from ISIC, from other providers, and how they themselves can take certain steps that improve the risk profile of the project.
So this is a knowledge gap, right, where you're like, hey, I didn't even know I could get insurance for things like
Precisely,
that.
That's part of it, exactly.
That's just a very simplistic way.
And part of it is, one of the trends that we're seeing is that, of course, governments are more and more reluctant to issue government guarantees to projects. So we have a lot more PPPs, a lot more concessions, where there simply is not a government guarantee, at most maybe a comfort letter to the state-owned enterprise which is doing the project, but governments are much more reluctant these days, so we really need to be creative in how we then overcome the private sector's reluctance to invest when there's not a government guarantee. Already with a government guarantee, often it's difficult, but without a government guarantee, many private investors are quite reluctant, in fact.
Yeah, and that,
which is where the African Development Bank and others come in as well, to say, we are de facto adding a mitigation element because these are our member states.
Yeah, and that also gives people comfort and things like that. So there is a very blindingly obvious question that I think maybe people watching this are going, go on, Adam, you've got to ask this question. Why is the Italian government doing this?
That's a question, I would say, as far as I know, within the OECD, Italy at that point had responsibility for kind of this topic within the OECD.
Right.
I can't give you, unfortunately, a 100% answer. Yeah. We just know that at that time,
that's the background.
That's the background, yeah.
Right.
So they were part of this OECD working group, and the Italians took the initiative. That's as far as, unfortunately, I can't give you the institutional history there.
It's fine. I just seem
but
to
we're
think,
thankful to the Italians that they took the initiative.
Exactly, and it's just incumbent on me as an interviewer. It's just the obvious question.
Absolutely.
I felt like I had to ask it. So that's one side of things. We've laid out this framework. We're de-risking projects and so on, and that's all great, but where has this already happened? Do you have projects you're already working on where which are live and have been through that process? Can you talk a bit about those?
Absolutely. I mean, I think first of all, I mean, at this very time, we are working on at least 10 live projects which are still in the process of being developed, where obviously risk mitigation is part of the factor, and those, because they're live, I can't talk about in terms of naming them, but in terms of renewables, we've closed, for example, the Lake Turkana wind farm, and when I say we, it's more often than not the African Development Bank with any number of other actors, but
it's the bigger we.
Being the development bank of and for Africa, we obviously play a key catalytic role. So the Turkana wind farm in Kenya was a key project. Other renewable projects include Cabe Eolica in Cape Verde, as well as this is always a tough one for me, Tezi in Zambia, where I think one of the interesting things and a unique aspect of the African Development Bank is that's a project where, for example, we're involved both on the public side and on the private side.
Right.
So we're helping finance the private side, but we're also financing both the transmission lines and the equity participation by the government in the project. So it's an interesting case where the African Development Bank can be involved on both sides, which for the private investor gives a lot of comfort implicitly.
Yeah, and one of the things that I wanted to explore, and it may be slightly off topic, but I've been doing a lot of reading around, and I'm in the process of formulating an article on this, where there is a lot of, in the developed world anyway, a lot of sort of perceived risks associated with traditional utility models.
Correct.
Where it's been the banked investment, where pension funds have gone into it and everything, and there was a recent release by Barclays saying that actually, due to distributed generation, that holy grail of investment, which is a bit like a gilt-edged share or whatever, is no longer of that profile. In Africa, it seems to me that there seems to be a jump towards this distributed generation model, which is actually potentially much more sustainable for the continent as well. And you mentioned renewables. Is that the primary push, renewables? And is that where a lot of the action is?
Well, I would say, I mean, I think that's two different questions. I mean, renewables, that's the source. I mean, that's one question.
Yeah.
I think in terms of the structure of the deals, I mean, something that I've been seeing as a development over the last couple of years, which goes to a previous point I made, is that more and more the governments are not doing it themselves. They're foisting it or pushing it down to their usually state-owned utility companies, which may or may not be terribly creditworthy, and the less creditworthy they are, the lower the rating, if they're even rated. Obviously, the more of a challenge we have on financing and mitigating the risk of that state-owned utility. And so this is something where I am seeing a very big development that, you know, more and more we're seeing projects that involve these state-owned utilities either as co-developers, as off-takers, as the ones who are responsible for developing the transmission, for example. And you can have the best generation in the world. If you don't have the transmission, you're stuck. So there's a lot of work that has been done and much more work that needs to be done on how you make these projects bankable. It's not I'd say that's hopefully one of the things we'll be discussing at the forum, and certainly probably for years to come, because it's a key element. Again, as I said, the governments are not willing anymore to give the guarantees that they used to, and so we, African Development Bank, other players, have to come into the breach in one way or another, either by assuming some of the risk ourselves, by finding other ways of structuring it so that the risk is mitigated in other ways.
Are you seeing consortia coming together? And by that I mean, for example, in London, there's just been an announcement that TfL are going to become an off-taker for community energy programs because they are a high energy user. And I use that as an example of, I could imagine that consortia would come together where you say, right, okay, we're building a wind farm, and we're going to put next to that a industry or something that can use that type of power, so that the off-taker isn't necessarily the utility, but there's a microcosm almost being built. Is that something you're seeing, or there's the potential of maybe?
That's a trend certainly that I've been seeing, especially for the IPPs. The idea of having an IPP that has some kind of an anchor off-taker that is a private sector off-taker. It's a model that I've certainly seen in Latin America before, and that I think has some. Especially in some of the larger countries in Africa, has an applicability. I think when you talk about some of the smaller ones, there may be a limit in terms of local domestic resources. Another trend going to that, when you said consortia, I thought you might be going in this direction as well, is for regional projects.
Yes.
We just had a presentation here on Inga, and of course Inga is the grandfather of them all when it comes to these regional mega projects.
Yeah.
But I think that we are seeing whether it's in Mozambique, in DRC, in a number of other countries, Ethiopia, projects that have at the very least the potential to be regional projects.
And those regional projects, going back to your earlier point, that's where you need that transmission interconnectivity, because no good having this thing that can, on demand, pump out God knows how many gigawatts of hydropower if you can't send it anywhere.
Precisely, and coming back to the risk mitigation part, you're also talking about multi-country risk from an investor standpoint and from a lender standpoint. So again, I think the African Development Bank has a key role to play in those projects, because if you're doing a project that involves, let's say, Kenya, Uganda, and Rwanda, or Kenya, Uganda, and Tanzania, whatever constellation, from a developer standpoint, they're suddenly faced with 3-country risk or 2-country risk rather than just with 1-country risk. And our responsibility really is to try to ensure, because those regional projects are extremely important, especially for the projects for the countries in the interior of Africa, that may have limited access to the sea. And here I'm talking not only about energy, about transportation, etc. All kinds of projects. We have a key role to play in being a catalyst for those kinds of investments.
And it's also one of those I would feel, one of those ironic things, and we've seen it in other industries, where that perception of risk, because I'm now dealing with 3 or 4 actors or whatever, actually if you can start joining more and more people up, it has an ironic effect of de-risking it, because suddenly everybody has got skin in the game, right? So you're like, well, we can't tear that power line down because, hang on a minute, it's affecting all of us. It becomes a bigger thing.
I think that's true in theory.
Right.
Unfortunately, in practice, I think often national politics may
forgot
override
about the
certain,
politicians. Right? They get in the way.
I think when those who assess the risk of these things from the outside look at it, unfortunately, they tend to have an additive view of risk rather than a distributive view of risk. Sadly, I agree with you that the practical effect should be, that the risk is diminished. And again, what institutions, development finance institutions, have the luxury of doing is taking that long-term view, that our engagement with all of the countries who are our shareholders is a long-term one, and that we can help resolve those issues when they do arise in a way that benefits everyone, rather than having a zero-sum game approach.
Yeah.
And we can take the long view also towards returns, which obviously private investors and lenders sometimes cannot.
Yeah, they need a certain period. And
their shareholders are looking at what are the quarterly returns.
The time's ticking.
Exactly.
So unfortunately, we've come to the end of our time here. What I'd love to do, and I don't know how we do that, those projects that you're working on, it'd be great to sort of report on that, as they come to fruition, when you can talk about that a little bit more openly, because I think it's a great testament to some of the work that is being done and needs to be done. And thanks for joining us here.
It was
as well.
Great pleasure. Thank you.
Thank you as well for watching. This has been another interview at Africa Energy Forum in association with Engerati. As I've been mentioning in the interviews on Engerati, we're creating a Powering Africa hub where we're putting all this content and information on live projects and projects that are going to be live online for you to have a look at. So please do check that out. And thank you again for watching.